Housing market may be starting to show some cracks, but our next guest says don't expect anything meaningful to change until rates fall. Let's bring in Logan Motrashami. He's the head analyst at Housing Wire. Logan, welcome. Good to have you with us. Do you see this trend, higher rates, slightly dampening prices, continuing for the next several months, or do you see anything in the marketplace that could flip that script?
Hopefully rates stay high enough this year and next year to get total inventory back to 2019 levels. If the Fed is truly believing in the housing reset, this needs to occur. But traditionally speaking, when the economic data starts to get this worse, post-1982, bond yields typically fall into a recession. So we have a little tug of war right now. Can the economy stay firm enough to keep rates high enough, or does the recession pull bond yields and mortgage rates lower?
So getting the inventory and demand back into a greater balance means exactly what? In other words, that sellers keep listing, but buyers don't go for the price and the rate and the monthly payment they have to pay.
Here's the problem with inventory in America. A traditional seller is also a traditional buyer. And what we've seen in the last 5 weeks is new listings are declining faster now than in the last 2 years. So hopefully what happens is higher rates creates weaker demand. New listings every year accumulates, right? So it's the weakness of a demand that will get us back up there. And that's what I'm hoping will occur, that total inventory levels could get back to 2019 levels, which were the 4-decade low before 2020, but we have a more functioning marketplace in the U.S. when inventory levels are back there.
You know, the Great Recession back in 2008, 2009, and into 2010, really housing prices started to turn a little bit a couple of years before that, as I recall. You're not looking for what we saw then, which was a major decline in housing values, or are you?
If you're looking back in inventory levels, I think we got to 4 million total listings in 2007. The problem was back then, the housing market was cracking in terms of foreclosures and bankruptcies in 2005, 6, 7, and 8. Then the job loss recession happened after that. We don't have that kind of backdrop where we have forced sellers. It's a much different marketplace.
And obviously, on the thought that Diana mentioned, which is, of course, the cliche, but it's true, most cliches do have a grain of truth, and that is that all real estate is local. You would expect, I assume, that those housing markets that got the hottest will cool the most.
Naturally, that's the case. We see that in Boise. We see that in Phoenix. We see that in Reno. Those are a few pockets of the country. And then everywhere else is just kind of seeing slow inventory gains. So that's why the national inventory data is not back to 2019 levels. But those areas definitely for sure are already there.
Do you see
I would consider that a good thing for this country, that those inventory levels are back up there.
Do you see some markets wherever where you think demand is going to increase and prices will, if not just be stable, go higher despite the overall trend?
If mortgage rates fall back down again, like we saw in the previous decade, demand will pick up. But as long as rates stay at 5 to 6% level, demand should be very soft until that the rate aspect kicks in. And we've always had that happen in the past 10 years, where rates go up, demand gets weaker, then rates fall down. For right now, it's much different. We actually haven't experienced a housing market post 2010 where we've had 2 years back-to-back of mortgage rates above 5%. So if the economic data holds firm enough, rates should stay this high. If not, then traditionally what happens, rates fall and bond yields fall.
Logan, you gave us a lot of content there. We thank you. Logan Motrashami, we appreciate it.